And thank you, Stephen, for setting up that recording. But I will say this also about Jennifer. She has been coming as a guest speaker in my classes at SDSU and here at Miramar College for close to a decade, I think, for a long time, a long, long time. And she is just one of my favorite presenters. And you'll see why. She's just has a wealth of information to share, and wonderful for the business students, the entrepreneurship students. We have a lot of people here from the accounting classes I see, from finance, and it's great. You're going to love hearing from her. And I will say this, we're here at San Diego Miramar. I am the director of the Rec Innovation Lab, which is an on-campus business incubator. And Jennifer has been so helpful in the putting together, the forming, the planning of the Rec Innovation Lab. And she's a mentor here. And I can't say enough good things about you, Jennifer.
Oh, stop.
No, it's true. So, well, with that, Stephen, I know you had a couple things you wanted to also share with everyone before Jennifer starts.
Yeah, thank you for giving that great talk about Jennifer. But I just wanted to talk about why she's so awesome. For those who don't know, Jennifer has been around the San Diego entrepreneurship community for quite a while now. Starting when she was 25, she actually was asked to be a financial director at a company, which is amazing considering I'm 26 now, and I just can't imagine myself being in that situation. At 33, she became the CEO of her own company, Pro Box Office, but unfortunately that didn't fit with her. So she decided to start her own competing company, which she's working as the CEO now, Optima Office. Optima Office has actually grown much faster than her previous business. And I can only attribute that to how much work she's been putting in herself. And although her accomplishments in the business world are something to be proud of, she's also won many different awards, including the 2017 Young Entrepreneur of the Year and the 2016 Most Influential Woman Female Leader. So she has a lot under her belt, and she's going to have a lot of information and a lot of experience to give to us today. And with that, I think I'll hand it off to her to talk about herself.
Hey, with that kind of an introduction, huh?
Jeez, man, I got some big shoes to fill now. Oh, thank you so much for having me and for the kind words. Always willing to speak. And if there's something I can do to give back and help the next generation of entrepreneurs, always willing to do that. So I'll just go ahead and share my screen.
I was just going to say, whenever you're ready, you're welcome to share your screen. Remind all the audience, please turn off your cameras and your microphones and put the questions in the chat. Perfect. So we can see your screen. So you're good to go.
Got it. Very cool. All right. So I don't know how many of you are already looking at your financial statements, have started businesses, have started doing the cash flow forecasting and budgeting and all that good stuff. So this might be premature, but for those of you that have started doing these things, hopefully this presentation is helpful and it at least gives you some sort of value and helps in your future successes as an entrepreneur.
And I was going to say, Jennifer, we do have people from different stages. We have some people here who are in Business 100, so their very first business class, and then others who, they're on their third or fourth startup. So you've got the gamut here.
Yeah, and this can be somewhat interactive. I mean, I only have about 15 slides, and so I don't want to overwhelm with information. But if there are questions that come up during the presentation and people are have a burning question, feel free to interrupt me. I'm fine with ad hoc. I don't mind being interrupted. Just let me know how I can best make this an effective learning session for everybody.
Awesome.
You guys already heard my bio, so I'm going to skip this slide. But I will say that Optima Office, I'm so excited. We are in our third year of business, and we're hoping to do about 7 million in revenue this year. We're already at over 70 employees. And it's, to me, I find so much just joy in hiring people and giving people an opportunity and then helping clients with their books. Making sure that everyone has accurate and timely financial statements is so incredibly important to me. So I'm doing what I love, and I hope all of you do what you love at some point in your life, but maybe you already are. Maybe you're already doing what you love. Today, we're going to talk about, how do you read your financial statements? It's not rocket science, but it's also not super easy if you've never done it before. And I know a lot of entrepreneurs who have been in business for a really long time and they still don't know how to read their financial statements. So hopefully we'll do a little bit of that today, and then understanding how to actually forecast out your profit and loss statement and forecast out your cash. As an entrepreneur, you never want to run out of cash. You always want to have a capital reserve, whether it's line of credit, whether it's friends and family that that if something bad happens, you are able to get some cash. So cash flow forecasting will always help you at least prepare for what's to come. And then lastly, we'll talk about some key performance indicators that I think are relevant for pretty much every single business. So hopefully you learn something in the KPIs that you can bring back home. I think that bad financials are like the guy on the left, and that good financials are like the lady on the right. We can kind of consider them like teeth, right? Like, do you want really bad, gross teeth that don't match, or do you want really good, healthy teeth? So, and hopefully everybody wants nice teeth. Let's start with the balance sheet. And for some of you, this might be a little elementary. So those of you that are in the 100 course, hopefully this is something new that you will learn. I can't talk. So the balance sheet is a snapshot of how much you own versus how much you owe. So your assets are what you own and your liabilities are what you owe. The difference between the two is going to be your equity. It is really used as a tool to understand, are you healthy? Do you want to own more than you owe? Likely yes, right? So that's why your current ratio is something that's pretty important. You want to have more assets than you have liability, and you want to continue stacking equity into your business and having a positive retained earnings balance every single year. Retained earnings is really, what have you been able to retain over the year and over the lifetime of the company? Every year on 12/31, you roll your net income or net loss into your retained earnings balance. We see a lot of companies that don't do that, and they should. Hopefully that's helpful. This is a quick snapshot of what is your balance sheet. And what to note that I find really important is your balance sheet. Every single account on your balance sheet should move every single month. And if you find that there's an account on your balance sheet that month over month it doesn't change, there's probably an issue if it's not your security deposit or your retained earnings. So those accounts don't change throughout the year. Security deposit's going to change, when you move out of your lease, and maybe you don't have a lease, and so then you'll never have a security deposit, which means that every single asset account should move. Your bank account moves every month. Your accounts payable balance, your accounts receivable balance, your loan balance, interest gets accrued. So make sure that your balance sheet accounts are always changing every single month. Let's move on to the income statement. And I put balance sheet first because we run into a lot of companies that their balance sheets are so wrong that their P&Ls are wrong. So I don't even want to look at a company's P&L until I've actually looked at their balance sheet and made sure that every single account on the balance sheet ties to a statement or a schedule. And if it doesn't, that means there could be some significant changes in the balance sheet, which would change your P&L. The worst change we've ever seen is a company that they were stacking their credit card balance on the balance sheet without actually coding the expenses. And so when they'd make the payment, the cash would go down, but the liability just kept getting bigger and bigger and bigger and bigger, but in the wrong direction. So we had to change their balance sheet by almost $2 million, their P&L by almost $2 million because their balance sheet was wrong. And they were really pissed off at us, but it wasn't our fault. It's like, where's the bad message? We're the messenger, right? So just reiterating how important it is to make sure you have an accurate balance sheet. Your profit and loss statement or your income statement is really used to look at what are you earning every single month in revenue, and what does that revenue cost you to earn? So your cost of services, and then all of your fixed and variable costs, such as all your general and administrative costs, rent, any other kind of overhead, marketing charges, professional services fees. So that's a monthly, and then there's an annual income statement at the end of the year that you want to look at. How did I do the entire year? You should also look at it every quarter. So putting together a budget, P&L to budget is very important. It's really measured the profitability. So how are you performing? Are you losing money? Are you breaking even? Or are you making a profit? And if you don't know the answer to that, then you're flying blind. You just don't understand what's going on in your company. And we find a lot of, especially younger entrepreneurs and people who haven't been in business for very long, they kind of fly by the seat of their pants. And then when they actually get a financial report, they're like, whoa, I've never seen this before. How do I even look at this? So make sure you don't make that mistake and you really start understanding your numbers as soon as possible. To note, this is not what you would use to manage your cash. So there are so many items that could go on your balance sheet that will never hit your P&L, but that are going to affect cash, either positively or negatively. And so some people, if they're looking at their P&L, they're like, wow, we're profitable every single month. But let's say they have a lot of deferred revenue, or they have some accrued expenses that they're not managing, and then they really aren't managing their cash as well as they think they are. So, and to say managing cash flow, it's really important to know what your statement of cash flows is on a monthly basis. So where's your cash going? Is it going towards finance activities, operating activities, fundraising activities? What are you doing with your cash? And it's really at the end of every single month, and you spend $100,000, what did you use that for? So make sure you at least look at your statement of cash flows. And the way you do that is you're comparing items on your balance sheet, what moved on your balance sheet every single month. So here's a snapshot. I'm not one to read slides. If you haven't noticed, I'm not going to read verbatim. All of you can read, I'm sure. And so I want you to kind of look through what your assets and your liabilities and your equity are, kind of what I've written down here. But while you're reading that, I will go on to this balance sheet here and show you the kind of the basics. So your assets, your current assets are going to be things that you can cash in within a year. So 1 year of liquidity. You've got your bank account, all of your cash accounts. You've got accounts receivable, and hopefully these are things that are due to you within 30 days. You don't want people to owe you money for days on end. This is going to be any kind of maybe some kind of a deposit that you can get back in a year. Prepaid expenses. So let's say you prepay a bunch of events, you prepay insurance. There's a lot of things that you can prepay that you're going to amortize out every month. That's what prepaid expenses are, typically something within a year, except for the Bali trip I had booked for Entrepreneurs Organization that was supposed to be a year ago, and it's still on the books because of COVID. But typically most prepaids are within 1 year. Your other assets are going to be fixed assets. They're going to be accumulated depreciation. There's a lot of other things that are maybe over 1 year at length. Your current liabilities are things that are owed within 1 year. So these are all things that you need to pay within a year. So usually your accounts payable, you need to pay your credit card balance on a regular basis. You're not falling in the trap of paying a lot of interest and fees on your credit card. Definitely don't get late fees on your credit card. That messes up your credit. Not a good idea. Make sure that's something that's always on your radar to pay monthly. And then any kind of accrued expenses, even accrued paid time off for your employees should be listed as an accrued expense, unless companies that have an unlimited PTO policy aren't going to have accrued paid time off. But those are all things that are due within a year. Long-term liabilities are usually going to be a longer loan. Now, line of credit doesn't necessarily need to be in here because some line of credits are due within a year. And if they are, then they would go into the current liability section. But long-term liabilities are things you might owe 2 years from now, 3 years from now, 5 years from now. And as I mentioned earlier, retained earnings is the earnings that you have retained over time. And then your net income is the net income for this specific year. So the net income for 2021 is going to be in here, but all the net income from all your previous years is going to be in your retained earnings balance. Don't want to state the obvious, but your assets should always match your total liabilities and stockholders' equity. It's extremely important that you know assets less liabilities is your equity. That's why you don't want to own more than you owe. I don't know if there's any questions on the assets, liability, and equity. Happy to answer them. If there are, I'll keep the chat kind of on a different screen here. Let's move on. That might be been a little bit too simple for you, but hopefully you learned something. I'm going to start with the profit and loss statement. I've already described what the profit and loss is, and I can share. Here's an example of one. I'll go back to that last slide. But you've got your revenue, you've got maybe some project income, and you can slice and dice your revenue. There might be different revenue categories, revenue for different departments, revenue for different products and services. So your revenue line item, you can have 10 things on there. You can have 2 things on there. You can have 1. So revenue, your cost of goods sold are the cost of service, your clients, the cost to produce your products. You want to make sure that your cost of goods sold is an accurate number so that you know your true gross margin. And then you've got your operating costs. So all your general and administrative costs, any other kind of income that you might get that's not regular, you'd want to put down below the line. And then expenses such as interest, depreciation, tax expenses, those are all going to go in your other expense. So here's an example of a normal 1-year profit and loss statement. But let's go back to this last slide on how do you do a forecast, or a budget. I mean, it's kind of the same difference, but if you're forecasting out your profit and loss, what I want everyone to do, if you have a business or you have a P&L that you can look at, you're going to take your 2020 profit and loss statement and you're going to put it into one column for each month. So January should be next to February, should be next to March, all the way down to December. You're going to have a year-to-date total. And then to the right of that, you're going to want to have an average cost so that you know our average revenue. What is the average that you earned or spent throughout the year? And then you're going to kind of look at any kind of trends. I want you to take that 12-month snapshot, and then I want you to add 12 additional columns at the end. And that is going to be what you use to forecast out 2021. Obviously, January and February are done. Can't make any changes to those at this point in time. So you could forecast out the rest of March, and then you should absolutely make sure you forecast out April through December. Now, I like to look at trends. For example, if marketing costs are $500 a month consistently, and you're not going to make any changes, then you can assume those next 12 columns for 2021 are probably going to be $500 a month. However, if you've decided to spend more on marketing, and maybe it was 200, 300, 400, 500, 600, 700, but the average was 500, I wouldn't necessarily want you to put $500 down because it might be $700 or $800, which is what you ended the last couple months of the year with. So make sure you're not just using an average, because if there's an upward trend and that's going to continue, you want to build that into your forecast. If there's a downward trend, you're going to want to build the downward trend into your forecast. Averages are used to say, okay, what was the average that I spent on a yearly basis in this specific category? But what do I anticipate spending for the next 12 months? And so rent's probably not going to change. Unless you're growing substantially, your insurance costs are probably not going to change. Your workers' comp will change. Your workers' comp insurance will change if you're hiring people and your payroll wages are going up. So take all of this into account and make sure that you're really filling out every single column on your spreadsheet. So you've got all your income projected out, you've got all of your cost of goods sold projected out, and then you've got all of your operating costs projected out. And make sure you're at least breaking even. Now, if you're not breaking even, there's a couple options. You can either increase revenue, and hopefully you can actually, you have the ability to do that, or you're going to have to reduce some expenses, or you're going to have to know, hey, I'm just not going to be profitable for the next year, but then I better find a way to get some capital, get some investors, or figure out, how you're not going to go bankrupt or be insolvent because you ran out of money. And so if you're not breaking even and you don't have a plan to make, be profitable, you could run into pretty big issues later on. And I've seen a lot of entrepreneurs run out of money, and they had very high hopes. They were, I want to say, almost dangerously optimistic. And so it's great to be optimistic. I'm super optimistic myself, but I also want to be realistic. Hopefully that helps. I might have gone on a little bit too long about that, but I think forecasting out your profit and loss statement is super important. So again, this is a picture of a profit and loss statement. I want to point out one thing on this now that we've kind of talked about how to do a forecast. If you'll note, the gross margin, your gross profit margin is 38% every month here that does not have project revenue. So not that project revenue is not going to have any cost associated with it. It could, but let's say you just get some extra fees and your costs aren't going to incrementally increase. Well, that might give you a profit margin of 53% this month, another one of 41%. So if you're going to put a formula here on your gross profit as a percentage of revenue, and in this case, it's 38% of income, then make sure you're not tying it to a number like some kind of a project revenue that you can't predict, that's just going to come in sporadically. So there are going to be anomalies while doing this, and you're going to have to be a little bit particular on every single month looking at where your revenue is coming from and how much that revenue is going to cost you from a gross cost of goods sold or cost of services standpoint. One thing you'll know is the personnel costs on this are going up. Starts at $7,000 and it ends at almost $10,000 for the year. And that's also because the revenue is increasing. So you started at $35,000 and then it went to $48,000 by the end of the year. I believe I put in like a 0.03, 1.03 multiplied by the previous month so that it continues increasing by 3.5% or so every single month. And as a result, your personnel costs might go up. Sometimes if those people are tied to the actual revenue itself, you might even put it under cost of goods sold. That might be your cost of servicing the product. So there is a difference between personnel labor for cost of goods and personnel general and administrative people. I don't know if we have any questions about this, but somebody said, do you think QuickBooks can help beginners? I think it can. I think as long as you're recording everything into a system and you're expensing it properly. One thing to avoid is just completely using all cash accounting, because you might not really know the score. If you're doing all cash accounting, it's better to do accrual accounting. And if you're not experienced with accounting and finance, it might be a little more difficult to do. But if anything, if you're putting everything into an accounting software, or Xero is another software, then that's the best way to do it. I don't know if it can necessarily help you manage your finances, because QuickBooks doesn't do a cash flow forecast. So you cannot manage your cash through QuickBooks. You have to export your cash activities, put it into a cash flow forecast, and then kind of manage that every single month or every single week. So a lot of people put these grandiose sales plans. They're like, I have this big, hairy, audacious goal. I'm going to triple revenue. And then they realize, oh, shoot, I don't have enough employees that can fulfill this. Or, if you have these big, audacious sales assumptions, maybe you need to hire a salesperson, or maybe you need to increase your marketing budget. And so sometimes people are very unrealistic with their goals, and they're not tying their expenses to what they think they're going to do from a revenue standpoint. If there are, we had a company that actually did, because of COVID, they tripled their revenue. And they didn't have enough, they ran out of inventory, and then they had production problems. And then by the time they ordered all this inventory, then they ran out of room in their facility. And so, if you're not planning for a revenue increase and you don't have the facility requirements, you don't have the production requirements, you don't have the capacity in any other way to fulfill on the projected revenue, or on the flip side, if you overplan and spend too much and then the sales aren't there, then you might run into a problem where you need more capital. So making sure that you have enough capital. If you need to take on debt, that you take that on when you don't need it. The last thing you want to do is scramble at the last minute when you need capital. Get it early. Get a line of credit, even if you don't need it. I mean, we took out an EIDL loan. I believe we got about $150,000. It's just sitting in my account. I don't even need it right now. I'm probably not ever going to need it. Probably should just pay it back because I'm paying a little bit of interest on it. But 3.75% isn't that much. I just took it because if I need it, I want to have it there. Fortunately, we're going to get ourselves into a better interest rate situation here soon. We're going to line of credit, and that way we can just get rid of that EIDL loan. But the point is, even though I didn't need it, I took it because I always want to have enough cash to run my business. I employ 73 people, and I never want to miss a payroll. So just make sure that you're really planning in advance for your working capital needs. You know, what if you need to buy trucks for your business? What if you need to buy additional inventory? Need to hire a couple more employees? So just do a reasonableness test on your forecasting. Make sure you're at least breaking even. We need people to be profitable.
So Jennifer, it looks like there's a question in the chat. What accounting system, it's coming back to Philippe's question, someone else asked a follow-up. What accounting system do you recommend for startups? Any free accounting software?
There's not, you know what? Nothing's free. What are they getting from you? Are they getting your information? I would say steer away from free things that are collecting your data, unless you don't mind people having your data. But you can go to QuickBooks Online for pretty inexpensive. We have a wholesale account, so we get QuickBooks Online login for like $25 a pop. I mean, I don't know anybody that wants to start a business that can't afford $25 for a QuickBooks Online file. So QuickBooks Online is a really good starter program. I think Xero is also a good one. That's Xero. It feeds into everything quite easily. I think a couple of people I've talked to just in the very initial phases have used Freshly. And I don't know how robust Freshly is. I've never used it. But I would say that the easy bet is just QuickBooks Online. There's a lot of great softwares out there. I mean, obviously QuickBooks Desktop would be better than QuickBooks Online, but it depends on where you're at in your phase of business. You've got Sage Intacct, you've got NetSuite, you've got Timberline, you've got government softwares like Uninet and Deltek. You've got Acumatica for inventory and stuff. So there's probably 30 softwares out there, and just make sure that you select the right one for your business, for your budget as well. We just did a NetSuite implementation for a client that cost a little over $200,000, and that was just to buy the software and implement it. So there's expensive ones and there's cheap ones. The other question is, do I recommend going through a payroll company? Absolutely. Don't try to do payroll in-house, because the second you mess up your payroll taxes or you don't submit something on time, you could be fined, business could be shut down. There's all sorts of problems that you can run across by not having a professional payroll company. I mean, worst case, you use Intuit payroll. But again, with Intuit payroll, you still have to manage your own deadlines and your payroll tax reporting and stuff. They don't do everything for you. It's cheap, and it's cheap for a reason. I would probably recommend a more local company, maybe Coastal Payroll. They do a great job. TPC Payroll, it's the payroll company. I even really like a company called Pink Payroll. Their owner's fantastic. They're really good customer service. Once you get a little larger, I mean, we use Paylocity, and Paylocity is probably the cream of the crop. It's probably one of the more expensive ones, but their reporting is phenomenal, and they do a lot of our benefit administration. We do a 401k match for our employees, and so they help facilitate all of that. Lots of options. It just really depends on your business and what's right for you. All right. Some of you might have already had a chance to read this about cash flow forecasting. Basically, it's super important. Don't miss out on doing cash flow forecasting. I always recommend doing a 13-week cash flow forecast, which is 1 quarter. And so, what do I start the quarter with? What do I end the quarter with? And so there's really no surprises. I actually do my cash flow forecast. I add to it daily. I am on it. That's the only accounting task I still do as a CEO. I have 5 people in my accounting department. I have a director of accounting who's phenomenal. I have a CFO. I actually like to do it myself because it really helps me keep my finger on the pulse. But I've also been an accountant for 20 years, so I know how to do it. Make sure you always are planning out as best you can for your cash flow forecasting, and make sure your accounts receivable and your accounts payable reports are up to date. Because if they're not, then you don't know what money needs to go out for your accounts payable, and you don't exactly know what money's coming in for accounts receivable. So having that weekly accurate on a weekly basis is crucial. And then if you want to go out and get financing, or you need a loan or whatnot, you're going to need to make sure that your financials are accurate so that you can give the bank a set of numbers that they can read and that they trust you. If they get a bad financial statement, they're going to be like, what is this company doing? I'm not going to loan money to them. They can't even get their financials right. So we get a lot of referrals from banks. They're like, please help this company. Their financials are a mess and we're not going to loan to them until you fix it. So briefly, I think everybody kind of gets this. What is your cash inflows and what are your cash outflows? So I'll let you read this real quick. I hate reading slides, so I'll let everybody just kind of take a look at this on their own. I'm going to take a sip of my tea. So the most important thing is you really understand what's coming into your business and how you get money. It's not always just about sales, right? It could be about money that you've raised. It could be transfers from a savings account. So what is actually coming in and affecting your cash flow forecast? And then what expenses are going out? It's not just going to be stuff that's on your profit and loss statement. You might think about principal and interest payments. Your principal payments are never going to hit your P&L. Your principal payments are always going to go right to your balance sheet, but you still need to make that payment. It's still cash. And so that is still a cash outflow. If you let's say you bought 10 computers at $1,500 each, then that is going to only go on your balance sheet initially, because that's now an asset. It's a technology asset that you're going to likely amortize, kind of depreciate over a 3-year period. So you're going to recognize $500 a year as that depreciation for that computer. Again, those are things that are going to go on your cash flow forecast that are not going to probably ever hit your P&L, except for when you're expensing the depreciation side of it. So here's an example of a cash flow forecast. This was a weekly one, and this is just how much cash you have at the beginning of the week, how much you're going to collect from customers. Maybe you have $137,000 prior to spending, and then you've got your payroll, you've got health insurance, you've got credit card payments, and then maybe you're paying some other vendors $12,000. You spent 141, you only had 137, which means you had a deficit for the week, which means you have a negative balance. Well, that's something you want to focus on. So you're going to want to fill this out as much as you can. And I can give you guys copies of these slides or some templates, no big deal. But I would just definitely encourage you to have something like this, even if it's high level, so that you're managing your cash flow on a weekly or bi-weekly basis. So before we switch to the next topic here, KPIs, do we have any questions about cash flow?
Yeah, I do. Hi, my name's Ashley.
Hi.
Do you prefer that I share my video, or what works best for
Yeah,
you?
it would be great. I mean, if you, well, I'm sorry, I didn't mean to talk over you, Jennifer, but if you'd like to, we'd love to see you, Ashley.
Sure. So how often would you, recommend updating your cash flow? I understand that, of course, sales and things like that are changing even on a daily basis. How often would you recommend, revisiting these things? And also, would you recommend having a cash flow, projection for the beginning of the year? And how do you kind of manage that along with your expectations or kind of your ambitions?
Yeah, great question. I think that at the beginning of the year, even now, if you haven't done it, do it now and forecast it out through the end of the year, what you think is going to happen. And then every day or every week, you can change it. Let's say you land a huge customer and you would put on your cash flow forecast that you're only going to get $20,000 to $30,000 a month. but then you land a customer that's like $30,000, just that one customer. Well, you're going to want to update the rest of the year's cash flow forecast. You can constantly update your cash flow forecast. I wouldn't recommend always updating your budget. I think you set a budget, and unless something drastic changes or you really need to redo that budget at the end of every quarter or something, then you can redo your actual true budget. But cash flow is going to always be changing. There's always going to be new things that come about. And so as soon as you know about that new thing, put it into your cash flow forecast. I actually just updated mine because I didn't realize that a bunch of people in my company have credit cards, and they started getting some new dues and subscriptions on there. And somehow, I don't even know how the team did it. It was close to our budget, but they spent like $20,000 in credit card payments or credit card expenses in the month of February. And I'd only put like $12,000 each month for credit card payments. I'm like, what the? So I had to update it. And I'm like, okay, is this what we think we're going to spend from here on out? And so I updated all the credit card payments for the rest of the year to be a little bit greater than had originally anticipated, if that helps.
Yeah, that's very helpful. Thank you so much.
Yeah, I'll send you guys some templates too. This is a weekly one, but we've got some good ones as well that are bi-weekly. All right, key performance indicators. And some of these can go way more into detail. Some of the cash flow and stuff can go way more into detail. But I tried to just scratch the surface with it. We had kind of a short time frame here, and I wanted to get as much content, valuable content to you as possible. But this was kind of funny. They just filled all the numbers back in. They didn't like their graphs, so it's kind of a funny little meme here. But the most important, I would say one of the more important ratios is your current ratio. I think I mentioned this earlier on, is that what are your current assets? And then you divide your current assets by your current liabilities. And if it's less than 1, that means you owe more than you own, and that can be a little bit problematic. So make sure you have a plan to fix that. I usually like to see people's current ratio at about 1.25 to 2 or even higher. I mean, mine's not at 2 right now, but it's close. So I really try to focus on accumulating more assets than debt. The only difference between the current ratio and the quick ratio is that your quick ratio takes out inventory. Oftentimes people have inventory that's been sitting on the shelf for a really long time. And that's the last thing you want to do is have stagnant inventory. You want to always have your inventory churning and making sure that you're selling it or doing a flash sale if you have to reduce the cost just to get inventory out of your warehouse or accumulating inventory. And then you also don't want to run out of inventory. So that's another subject for another day. But quick ratio is the same thing as current ratio, they just take out inventory. Days sales outstanding. Now this is another super important metric. My days outstanding currently at Optima is just about 20 days. That's pretty good. That means it takes 20 days to receive most average customer payments. I've got some that are 90 days old and 60 days old. And there's only a couple customers that are, and that is because COVID majorly impacted their business. There may be restaurants or retail, maybe a not-for-profit. And so they've asked me for extended terms, and I feel bad for them. So I'm like, okay, let me see how I can help. But you want to know how long it takes you to receive your money from your customers. So what you do is you take your accounts receivable balance at any current point in time, and then you divide that by your daily credit sales. So let's say 30 days in a month, $300,000 in sales, that's $10,000 a month in sales. So I do $10,000 divided by your accounts receivable balance, and that's going to give you your days outstanding. That's a good number to know. If your days outstanding are more than 45 on average, you have an AR problem. You have a collection problem, and your customers are taking advantage of you, and you're their bank. And so don't be their bank, charge them interest, and really get a rein on that, because if you don't, it can really take you out. One really quick tip, and I hope you'll remember this one. If you have customers that have not paid you and they're not communicating and the bills are sitting there, buy pink paper. I know it sounds silly, but accountants don't like pink paper. It just stands out like a sore thumb. I mean, all my papers on my desk are white, right? There's no pink or yellow paper. If you send a pink invoice to a company, they open it up, the accounting department's like, oh my God, it's like, let me get rid of this. And so we've seen a really high success rate with sending out late invoices on pink paper. And people will tend to pay because they don't like that pink stack sitting there. And to make it worse, you put a red past due stamp on it. And then you follow it up with a phone call. Worst case, you have to hire a collection company, but don't let people take advantage of you and get your sales past, 45, 60 days. Not ideal. Your burn rate is how much cash are you burning through on a monthly basis? So it's almost goes hand in hand to a certain extent with your break even. But again, your break even is more about your profit and loss statement and not necessarily about cash. So you can kind of use it to do a tool of, okay, what does it actually cost me on a monthly basis to run my company? And then you want to make sure that you have a couple months cash on hand. I know a lot of businesses, we have some as clients that have a week of cash on hand. They're just flying by the seat of their pants, hoping that new revenue comes in, new sales comes in. Those are the customers I worry about them not being able to pay. And so we keep our eye on customers that have really low cash balances and their customers are paying them late. Because if you don't manage that well, they're going to likely run into some problems. Make sure you know your burn rate. Inventory turnover is just how fast are you turning over your inventory. So you take your cost of goods sold on a snapshot of time, and then you divide it by your average inventory. And that'll give you how fast your inventory is turning over. Here's some examples of some charts and graphs that, let's say this is a professional services company. What is your average invoice per month? That's more of an operating metric. How many clients do you have? What is your current ratio? You might want to know, why did it dip from 1.72 to 1.51? That's a pretty big difference. One thing that could cause it to go from 1.72 to 1.51 might be a shareholder distribution. Let's say the shareholder took out $100,000 cash. Well, their assets went down by $100,000, and then they took $100,000 in distribution. So that's not going to affect their liabilities. It's going to affect their equity section, but that's still going to affect their current ratio because their current cash balance went down. That's one way that something could have happened here. There's a lot of reasons why your current ratio can drop, but you'll want to know why. Why did your current ratio drop, and how do I get it back up? You might want to look at average revenue by business day. We find a lot of customers don't understand this. So they're like, God, we had a really crappy February. Well, February only had 19 business days. You're a professional services firm and you bill people by the human labor. So if there's less human labor days, you're probably going to have less revenue. It has nothing to do with February itself. It has to do that February had less business days. So another metric is really understanding, is your business affected by business days, or is it affected by the products that you are selling? So average revenue by business day for a product company might not necessarily matter, but you might just want to run the numbers and see. Might be just a good information, if anything. So even a not-for-profit might want to have a lot of these charts and graphs. Maybe how do they break up their revenue? You might want to do some charts and graphs on maybe a pie chart on what kind of revenue you're getting. I even do a pie chart. I want to know what CFO revenue we're selling versus how many controllers, what is our controller revenue versus what is our human resource revenue. We're trying to increase our human resource revenue. It's about 10% of our revenue right now. We want to increase it to about 15% of our revenue. So I want to see my pie chart go up a little bit. What I'm trying to reduce is a lot of our bookkeeping. There's not a lot of margin in our bookkeeping. So I don't want my lowest margin product or service to make it the largest percentage of my graph. I'm going to want to get my higher margin products and the services that we're doing a little bit better, financially on, to be the larger portions of my graph. So putting your revenue by service or product or department onto a pie chart is really helpful. Some of these graphs are I like graphs. I think a lot of people, you can learn more from looking at a graph than sometimes you do from just an Excel spreadsheet. That's it. I think I wrapped it up in my 35 minutes or so.
That was
we
awesome.
answered questions along the way.
No, that was really good. You're always so good about time. I love it. I love it. So, Stephen, did we get everything addressed? That was.
Yep, I think every question that was asked in chat got asked to Jennifer. I just want to say thank you, Jennifer. That was so much good information. I'm sure a lot of people are going to go back and watch the recording just so they can absorb everything.
Mm-hmm. I know I will.
Yeah, like
yeah.
20 times.
Right,
Yeah.
right. Yeah. Does anybody have any questions for the couple minutes that we do have left together? So Jennifer, is there anything else you'd like to share? Oh, sorry, Max. So were you going to ask something? I didn't mean to cut you off.
No, I just wanted to say thank you, Jennifer. That was great. Thank you so much.
Yeah. Yeah, happy to help. And then Tanya, if you want me to send you or Stephen some templates on cash flow, like a weekly cash flow template.
We would love that.
Really helpful.
Yes, we would love that. We would love that. And, we'll also post this recording. So if any of you want to see the recording, we usually have them up in about 24 hours. And so you'll be able to access it on our YouTube channel. And then if you send me those templates, I'll attach them. And then anybody who needs them can access them. So, and thank you, Stephen. Yeah, Ben, go ahead.
Hi, Jennifer. I thank you so much for coming to speak with us. I have just a quick question. Do you if we had no income and very little losses, do you still recommend putting the losses in our reporting the losses, or?
Well, if you're spending money, so if you own a company and you're spending money, even if it's $1,000, then you just reduced your tax liability personally, right? So you can take your business loss on your taxes, and you're not going to want to just keep that out in thin air. So I recommend to businesses that they're pre-revenue, all they're doing is racking up some costs, just put it in an Excel spreadsheet for now, put in the date of the cost, the amount of it, a description of what it was, and try to assign it like a GL code. Is it meals and entertainment? Was it research and development? Was it office supplies, professional services? So try to pick like 10 main categories, try to do it yourself in Excel for now. And then when you're ready to put it into an accounting system, you can easily have a company just upload the Excel worksheet, or they can do a journal. But you want to give that information to your CPA. You can take loss carry forwards, I believe now for 5 years. So you'll want to keep track of any business loss at all.
Great. Thank you so much.
Yeah.
Thank you. It looks like we had another question in the chat from the question was, what is the key point of budgeting? How to budget?
Well, the key point of budgeting is so you know the score, right? You want to budget because what do you predict is going to happen at the beginning of the year? Okay, well, I think I'm going to make $1 million, and I think it's going to cost me $500,000 to make $1 million. I'm going to make $500,000 in profit. Well, 6 months down the road, if you've only made $200,000 in income, but you've spent $180,000 in expenses, well, you blew your budget, and now you've only made $20,000, and you're supposed to be making, at that point in time, $250,000. So you'll want to know that information. You'll want to know, okay, am I tracking to what I thought I was going to track? And then also, if you're going to be looking for investors, you want people to invest in your company, or you want to give away equity, then having a budget that you can share with people and say, hey, this is a budget I put together at the beginning of the year. We're 90% accurate. We really know how to predict our revenue. We knew how to predict what it was going to cost us to generate this revenue. It just makes you look a little more credible if you've tracked it correctly and that you have a budget to actual report. If you're just flying blind and you're like, oh, I hope that we make $1 million, and you don't, then what did it cost you to incorrectly budget that number? That helps.
So part of the process is that you need to know, hi Jennifer, sorry.
Hi. You're fine.
So part of the process is that you need to know how much revenue, like how much you want to make. You have to decide that.
Put a plan in place. Yeah.
Well, if you started a business where you don't know how much someone like you should make, how do you decide?
I mean, you can do market research. You can look at what your competitors are charging. I always look to do a little bit of competitor analysis. Yeah. So you know, if you have no idea, then just do some research and try to come up with a number. I mean, be conservative because you don't want to blow out your estimate so bad. But if you have no idea what your revenue is going to be, then put something really small down. But the most important thing is budgeting out your costs.
Yep.
Because again, if you don't budget out your costs, then you could potentially run out of money.
Yep.
And you again never want to run out of money.
Yeah, it's just basic customer discovery, the very beginning stages of the customer discovery process. And yeah, agreed 100%. Even if you don't know what the revenue is going to be, you can get a pretty good picture by doing some, you know, basic secondary research and even primary research. And then like Jennifer said, the cost you do know, and you just don't want to mess with that. So yeah. I hope that was helpful.
Thank you, Jennifer.
So if you don't know your margin, you're in trouble.
If you don't know your margin, you're in trouble. I will give one quick example on margin that I think is very important. So I find this issue with a lot of digital marketing and media companies where they get a retainer for their services. They might get a $10,000 a month retainer, and then they have all these people on salary, and people are just billing a bunch of time to these clients. They're on retainer. They're not tracking their time correctly. But at the end of the day, the business is profitable. They're like, oh, we have a 30% gross margin. We're good. Well, how do you know that one of those retainer clients isn't losing money because staff are spending too much time on them? And so on the flip side, what if you've got these clients that you're getting a great retainer fee for, but you're not billing enough time on their accounts? Well, you might have a pissed off customer because you're spending all the time on an unprofitable account, and the profitable account and the good one, nobody's spending enough time on. And so the margins are completely disparate. So you're at risk of losing the customer that you're not spending a lot of time in. And the customer that's getting a ton of hours is probably super happy because they're majorly taking advantage, but you just don't know the score. So I think really knowing where are you making money by customer is crucial, or by product or by service line. Helpful? Okay. Cool.
Awesome. So, all right. Would you like to maybe take us out, Jennifer? Anything else you want to just kind of end it with?
I wish all of you all the success in the world. Make sure you're doing your budgeting. Make sure you're doing your cash flow forecast. If there's anything we can ever help you with at Optima, we are here to help. You have a lot of great bookkeepers and controllers and CFOs. So when you get to that point in your career, remember me. You can always find me. Link in with me. I love connecting with students on LinkedIn, and anything I can do to help you, I will.
Thank you so much, Jennifer. And thank you for everyone for coming. We will see you at the next workshop or the next class, if you're the class, and take care. Have a good one. Bye, everyone.
Thank you so much, Jennifer.
Yeah.
Thank
sure.
you, Jennifer.